I'm going to try and do my best to get a conversation going. I've attended a lot of these. I want to keep it pretty light and interesting because we've all heard how to pitch, investors and all that stuff. And so, when I was flying home from Boston yesterday, I said, I better start putting some thought into what we're going to talk about. We got to come up with some good questions. And I remember when I started interviewing for my first jobs, I told my dad, Dad, I get really uncomfortable with silence, and I just feel like this guy's just sitting there staring at me. He said, just keep asking questions. And when you ask questions and have the other person respond, conversation builds, and that's what we're hoping to do today. So the panel's been introduced. What I want to do, just so we have some feeling of who we're talking to as an audience, I wanted to ask you a couple questions. Who's attended a CONNECTpreneur in the past? Raise your hand. Who's a first-time participant? Who didn't raise their hand? All right, so that's everybody. Who owns a business? Who's seeking to raise capital? Who's worked with institutional investors before? Okay, so it sounds like a great audience, a sophisticated audience. I want to warm our presenters up as well, just to give them a sense and throw them some softballs. Just answer one-word answer. iPhone, Android, or BlackBerry?
Blackboard. Just kidding. iPhone.
iPhone all the way.
BlackBerry.
iPhone.
All right. Which industry will be bigger in 5 years? Drones, 3D printers, or driverless cars?
3D manufacturing.
Drones.
Sorry.
Driverless cars.
3D.
There you go. Favorite app you can't live without?
Slack.
Multiple attachments.
Angel, anything angel.
Hello sign.
Hello, Sign. See, I always get good app recommendations. I would say Podio or Evernote. And then, what's your favorite sports team?
The St. John's College croquet team. Alumni.
That's a first.
The Cincinnati Reds.
Go Navy. Who said that?
It's a really interesting feature that my daughter went to St. John's.
That's right.
And would tell me to say croquet, but instead I'll say her second favorite, which is DC United.
There you go.
Nice.
New York Giants.
Yeah.
All right.
All right, well, that's great. You guys are more than warmed up, so let's begin. I want to start just by talking about the market. It's a nice way to get going, and if you guys wouldn't mind, Leslie, let's start with you. What's the state of the market for companies raising capital today?
Well, I think that depends on which market you're talking about, whether you're talking about DC Metro, whether you're talking about the United States or internationally. The majority of my work is international. I would say that we are in a period of incredible fluidity right now. We've got a lot of cash going into the market. It's going in at two ends, the barbells, as I see it. The very early stages, because there's a lot of people experimenting and new angels and new platforms and crowdfunding and all that stuff is happening. And then you see, people like, Goldman Sachs plowing money into, late stage deals on the high end. So it's a good time to raise money if you're raising money for stuff that they want to buy.
I would agree with all of that. I'd also say what you're finding is that people, especially angel investors, are beginning to look across the country for new markets. For instance, I live in New Orleans, so there's a robust, believe it or not, a robust startup community there. There's also one in Cincinnati, and the list goes on. As you begin to focus on these secondary and tertiary markets, in fact, there are opportunities. And I'm a big believer in looking at those places versus our usual San Francisco's, New York. Look, if you want to compete against, some of the larger private equity firms, fine. But I think in terms of being a smart investor, go to these other markets or reach out to folks in those markets as well.
Such a small world. I just was asked yesterday if I would give a workshop for angel investors in New Orleans in September. So you're right, it's a regional thing, it's a growing thing in different communities. I'd say in the Washington, D.C. area, we're back where we were 15, 16 years ago in terms of a lot of activity, a lot of attempt at showing that we can be something beyond a government town. I think there's a lot of new things going on that people aren't aware of yet that we will see blossom. If you look at 1776, I got an email about looking at a company that was at the Dolphin Tank, not the Shark Tank, but at the Dolphin Tank that Springboard, the women's group, hosts in terms of deal flow. So I'd say the early stage is getting very vibrant here. There's a lot of angels and wannabe angels. The question is going to be, what do you do after that round? And I'm sure we'll talk about the Series A problem.
I certainly agree with all the comments. We live in frothy times. Market timing is very, very difficult. So if you're thinking about raising capital, this is a great time to go do it. To add to the comments, I'd say that in this area, one of the most exciting things is the level of experienced entrepreneurs. What I mean by that is people that have been through it once or twice or 3 times. 15 years ago, that set of people was much, much smaller here, coming out of a very few set of companies, right?
They were still working at AOL.
Yeah, right.
Or MCI.
Now you have series of companies that have gone through a full cycle of startup to mid-stage to through exit, have scaled revenue to 50 million or 100 million, and then spun out people. That pool of executives is probably, my estimation is probably 8 to 10 times higher now than it was 8 or 9 years ago.
That's about right.
That's a very exciting
MCI
factor for
because
the
that's
region.
That's where you came from.
That's great, guys. Leslie, to you, I see you started your career and had a very successful career at MCI, where you probably cut your teeth, learned a lot of things, managed people, and
We were young in
took
those
those
days.
skills. Do you see today's entrepreneurs doing that same track where they're doing the corporate thing and then jumping into business, or what are entrepreneurs doing today to get their start?
No, they're going directly. I'm on the board of an organization called Up Global, which is the parent entity for Startup Weekend, and we do global entrepreneurship activities in 200 countries around the world. You know, back in the day, quote unquote, when we were cutting our teeth as youngins at MCI, there weren't a lot of options. You know, the infrastructure for being an entrepreneur didn't exist. So you couldn't just go find a co-working space to work in. You couldn't go to some place and spend 54 hours and find possible co-founders and build an app. You didn't have all the cloud computing resources and all the technology infrastructure that exists today. We were just in the very early days of laying internet pipe back then. So that has changed. What's not changed is the entrepreneurial zeal. I'm so glad you said what you did about New Orleans, because in our work at Startup Angels, we focus on markets like that, the markets that we see, rising. When I got started, I was intrapreneurial. I was part of this small team that was tapped early on to go and build new products for MCI, and I'll tell you, back in those days, we were doing it all on mainframes with paper clips and Band-Aids, but we were given 6 to 8 weeks to launch a product nonetheless. So it's the same kind of skill set, same kind of sort of fearless drive, but different infrastructure around us.
That's great. Hey, John, you've been around this market for a long time. I don't want to make you feel...
Just long enough.
And just following on a theme Leslie just pointed out, it takes less capital than ever to start a business. You can rent infrastructure, you can rent software, you can rent it all, you can rent office space. I mean, I was just at Boston's WeWork flagship office yesterday, and I feel kind of hip, but I still wear a tie, and I did not feel in a very good place walking around these halls. But why aren't more people starting businesses today? You read the Wall Street Journal, they're saying entrepreneurship is at its lowest point ever. Why aren't people taking more risks?
This is utter bullshit to talk about lowest point ever. I mean, they're talking about 18% instead of 19%, and therefore it's a down market, and therefore we're all going to have to go get big jobs with big gas companies or oil companies. It's just foolish. The whole idea of trying to get data about entrepreneurship and about angels is the hardest part of the market to ever get any kind of solid data, because people lie when academics ask them questions. So I'll leave to you the issue about the entrepreneurs, but let me tell you about the angels. Everybody assumes that everybody has an angel around the corner. They're everywhere. There's about 5% of the U.S. population that is accredited or has $1 million net worth. So you only have about 5% of households that are capable of taking the risk if they, are sophisticated. Only 5% of those are ever thought at any one time to be active practicing angels. Yeah. So 5% of the 5% are capable of multiple investments, taking the risk, being a mentor, and only 5% of the 5% of the 5% do it in a sophisticated group, monthly meeting, multiple portfolio way. So what we're trying to do is try to get more angels out there so that there are more practicing entrepreneurs that will have the opportunity to have some risk capital besides friends and family. But I'm not too worried about not enough. I mean, you go down to 1776, you go to the startup weekends, I don't see a lot of empty seats. So it's a buzz. It's a buzz factor to talk about down 2% or 5%, but I'm not worried about it.
I got to say, I saw the same thing. WeWork hadn't been open more than 5 months and they've already taken over the full. I mean, once you a full building, once you have that flexible infrastructure that you can rent, it's going to be more easy than ever. And it doesn't take much to,
One more comment to what
Sure.
John said. There's another way to look at this entrepreneurship factor, which is new job growth. Large majority of new job growth is driven by new companies starting rather than existing companies adding more people. That's true over a very long period of time, 20 plus, 25 plus years. And so that dynamic is actually increasing, is accelerating. And so I don't think the Wall Street Journal comment's right.
Well, if I can just add one other point, I actually think the article's foolish. I'll tell you why. I mentor a lot of kids with college, graduate school. There's not one of them. Let's pick real numbers. Probably 10% of the group of kids I mentor say that they actually want to go work for a major company, or want to be a banker, consultant, whichever. The majority of them are trying to find innovative ways, if you will, to start a business. What can I do? What's disruptive? Who can I align myself with? That generally is the mentality. And I remember when I was a kid, the idea of being an entrepreneur was you go get, quite frankly, have a store or something like that. Right. Nowadays, it's ingrained in our culture, ingrained in our mentality, such that this is the norm. It's not a bad decision. People don't balk at you when you say, I'd like to start a business. This is the right time for it, and it's quite normal for young adults.
But I think, Joe, it's important also to have some terminology. Like I've been saying recently, that entrepreneur is to small business what angel is to high net worth or a rich guy.
That's right.
Or woman. So we have to really realize that the high-tech, high-growth Silicon Valley model of an entrepreneur is much different than somebody who just wants to start a business, have 2 or 3 employees, and not be themselves an employee of anyone. We have to make sure we're talking about the right terminology.
That's right. That's right.
Very great, guys. Hank,
Yes.
I think you're a later stage investor like I am. We tend to focus on companies generating 10-ish plus in revenue. And so it's a different market. I know I want to keep this focus on small business, but I think people would be interested in what's happening in our market. Why are things so crazy? Why are people financing to such levels? Why is there a bubble building?
Well, quite frankly, not the market that we see, you have a situation where there are a lot of people with capital, not enough quality deals. And quite frankly, I hate hearing that, which is why our focus is really on finding off-market transactions. There are deals out there, you just have to dig deeper to find them and actually execute them. And also, I think what's missing in the marketplace is having a thematic approach about each sector you're looking at. So for instance, we're in oil and gas. We look at oil and gas technology, we look at all sorts of themes where you find things. That's the only way to invest in this current market, not just, hey, send me a good deal with good parameters and so on. And that's the problem there.
Can I follow up on that?
Sure.
Great point. Money is a commodity.
Right.
And the entrepreneurs are in the driver's seat now in terms of choosing who their investors are. So what you're doing with that thematic investing is you're really adding to the cash your network, your expertise, your experience. And so as investors, I would say that's the differentiating factors you have to look for. By the way, whether you're talking about putting $50K in a startup or 10 million in a scale up.
And in fact, to add to that last point, so we've looked at probably 20 deals closely over the last 6 months. The same theme out of each one from the sellers. Who's going to be a value-added partner who can actually contribute to this deal and enhance us, whether it's to their network, their knowledge of the space. And we're operators. I've owned businesses, my partners have owned businesses, so we could get in there and actually help the company. It's the partners that they're looking for versus, hey, I'm going to fly down and see you once a month to make sure that you haven't blown up the company. They don't need that anymore.
Yeah, because they can get passive capital.
Right.
I mean, when you've got major private wealth management firms doing
That's
convertible notes into IPOs for Series D. I know of an organization who did that for one of the largest of the quote-unquote unicorns, where basically their investors wrote a convertible note to convert into equity at the IPO of this so-called unicorn. Like, come on, there's way too much cash out there on the high end, so you really have to be smart about it.
Right.
Hank, you just hit on a great point. My next question was going to go to Sever. Private equity firms, when they buy a business, they do bring in a CFO, get in good controls, know what the heck's going on, hire a sales team. That's kind of the playbook for how Hank and I will differentiate ourselves with management teams. How does a VC firm differentiate itself from other VC firms?
Well, so just to be clear, we invest closer to where you guys are, frankly. We're not control investors, meaning that we don't buy companies. We are minority investors. At the end of the day, we back teams, right? We back a CEO plus usually 2 or 3 others that are around the executive team. And then, frankly, we roll up our sleeves and help fill out the rest of the management team, CFO, VP of Sales, VP of Marketing, usually. Help with channels, help with the business model, et cetera. So and I think that the time of writing a check and leaving it behind and then monitoring later, those are gone. I mean, I think there's very few venture firms out there left, or even growth equity firms that do that. I think most investors that have sustainable investment models with a long track record need to get in and do the work to help build the company.
And to be controversial so that Leslie and I can compete with you, big heavy hitter, later stage, people in the audience should understand that the three of you would be somebody that very few people in this room probably would ever meet with. It's just because of your profile. Turns out there are less than 1,000 venture capital firms in the United States.
Mm-hmm.
There are less than 5,600 people employed in the venture capital industry in the United States. There's less than 1% goes from the institutional investors to seed investments, about 23% in the early stage. So what we really are here for most people is what do you do with friends and family, CIT, angels, and so forth, to build something that would be of your caliber. Because like with Edison, we know that's a goal for us 3-5 years from now. If we can get a company up to the $5-10 million revenue, some of you are out there to provide that service, but there are very few of you. There are hopefully tens of thousands of angels to help. And so the key thing I just want to leave with people is you've got to do due diligence as an entrepreneur on the funding source.
Right.
Not just assume that because they have money and you need it, that you should not ask questions and you should be sort of benign. It's very important that you have a good chemistry, a good relationship with the funding. The only way to do that is to do a lot of heavy due diligence, ask who they've invested in, talk to some of their CEOs of portfolio companies of theirs. Do not assume that just because they're rich, they're not angels from hell.
Well,
That's a good line.
Actually, you can reverse that.
Now one of the things that we do.
that's yeah.
Yeah. Well, one of the things that we do that we've done for a long time, maybe 15, 16 years, is we meet companies early. We looked at the last three. We finished investing Edison 7. We're raising Edison 8. We've looked at the data across Edison 7, 6, and 5, and we've known companies on average 33 months before we invest. So that doesn't mean that we're talking to them. That doesn't mean that we're in the investment process. We meet the company early, and then begin immediately to try to help. How? A lot of our CEOs are either public CEOs, have been through an exit. They represent angel investors. Sometimes they represent mentors. Our companies have become channel partners for early stage businesses. They're in the same space. We have 45 active companies between here and Boston, right? So there's a lot of network there that can help early stage companies just get off the ground, find an angel investor, find a mentor, find a board member, et cetera.
And just to bring home one point that John made, it is a date. You were actually on a date when you meet with the funding source. You have to make sure that your long-term plan is mutually aligned. Because I know a lot of groups, quite frankly, we're going through this right now with a recap of one of our portfolio companies. Our mezz lender is, good group, but perhaps not long-term idea for the longer-term value of the company. So my long-winded point is, make sure that you really think this is the right group for you, or else don't do the deal. You will regret it more than
Don't do the deal.
Because you're going to see them more than your spouse.
Yes. Well, if you have a spouse.
Let's change gears for a minute. You saw a lot of hands from the audience of people raising capital in the market to raise capital. John, I'll start with you, or maybe we'll just make it a jump ball, whoever wants to take this. Sure. What's the most common mistake entrepreneurs make when pitching investors?
Product instead of personality, or product instead of the earlier the stage. This is good because of the panel. Earlier the stage of the company, the more it's people for the investor. And so
it's always people.
Well, yes and no, because there are people not on this stage, but some VCs that are known to swap out people.
Yeah.
And so sure, it may be people, but right now we're only investing in the dreamer, the funder, the team. When we actually looked at Wedding Wire, this is a great story because sometimes they get away. Active Angel Investors was a group of 60, 70 angels that looked at deals once a month. Wedding Wire came in and pitched. At the same time they were deciding whether to take angels in their round, we were coming up with a decision that we probably didn't want to invest in them because, get this, too much competition, and B, the management team, the founding team, had no woman. And here we are, the wedding wire company with no woman and the arrogance of the guys that they could do it again. But it turns out before we could even make a yes or no decision, they decided to go with Martha Stewart and take the institutional money. So the lesson there for all of you is that it doesn't mean just because you have money that it's going to work out, because there's other kinds of money. There's strategic money, later stage money, friends and family money. So it's just fascinating that I say that there's too much reliance by the entrepreneur on selling us their product when we really want to get to know about them and the company.
I'll make a different comment on this question.
That's great, thank you.
Unrealistic expectations, you lose credibility. So when you think through how to talk about your business over the long haul, just pull it back down to earth, versus being outside the stratosphere.
But it has to have a hockey stick.
No. We'd rather see, so we invest in companies on the low end where they've hit $1 million quarter. It can be the company's first $1 million quarter, and it can be bookings. So, we see, now from a hockey stick perspective, no, it doesn't have to be. We'd rather see 30, 40% repeatable growth every year rather than try to shoot for 100% growth and then miss it.
Yeah.
Or hit 80% growth, but everybody feels like shit about it because you missed a number. Right.
Thanks. You hit on it, management team, and wow, this worked out well. That was my next question. What are the most important things you look at when you're assessing the team? What do you want to see? What kind of chemistry? What kind of backgrounds? What do you want to see?
I want to see a hacker, a hipster, and a hustler. I want to see somebody who knows how to write code, somebody who knows how to design it, and somebody who knows how to sell it, and that they work well with each other. Very often in the early days, you'll see a team that has one side of that mix, but not all of it, and they won't get very far without that. So I think that's one of the most important things for us.
One of the things we like is a management team that's willing to listen. I can't stand teams that think that they know everything. It's a big issue, certainly. But one of the issues for us is if you don't understand, if you're not willing to listen to what we're saying, other investors, or for instance, if there's somebody who can augment your team, we don't want to do it.
It's also very important to be able to describe and to be honest about failures in the past or problems in the past. It's probably more important how you describe how you overcame adversity or why something failed than it is to tell us why you're so good and how wonderful you are. Also disclose. If you think something that's negative in the background should be held off till the end when you seduce the due diligence process, and they won't mind that you had this negative that you just decided to wait until later. The most valuable resource of an angel and a general partner of a fund is time.
Yeah.
You waste our time and we walk away, you'll never get another shot.
For us, it boils down to, there's lots of factors, but we try to boil down to markets and teams, because those two factors have shown that generally represent 90+% of growth equity and venture returns over the long haul. There have been lots of studies about this out there. So we are thematic investors, so we do pick themes. Therefore, we pick segments and markets ahead of the company coming to present, and then we find the companies that live in those spaces. So then, therefore, it's all about the team at the end of the day for us.
There's one last point, which is I actually mentored for Idea Village in New Orleans.
Yeah,
and one thing I saw was that you had a lot of folks, one business in particular, a lot of folks who did not understand the other players in their space. So you'd ask them a simple question, hey, do you know about this company? Never heard of them. Do you know about this person? Never heard of them. You've got to really thoroughly understand your business, your sector, who's in it, the players, even right down, it was a local business in New Orleans that is in the art space, kind of, and did not know the local arts community and key drivers in that particular community. It's embarrassing. And so my point is, know the players, take the time, figure out if you can meet them. But again, we know those folks. We've already done our research before you even sat down, or at least we should have.
And Joe, real quick, one way to get around this problem of who to know is to have an advisory committee. If you haven't ever had a board of directors, you should at least have some kind of an advisory board, kitchen cabinet. A lot of the people pitching today talked about their advisors. I don't care whether they've invested in you, but if they're the kind of people I would have used for due diligence when I started my list of who to call, and they, oh yeah, I know them, I'm on their advisory board, I have money in them, think of how that elevates you among the crowd, because it is a funnel approach, and if we're looking for any reason to say no. Due diligence, in my mind, is getting to know as fast as possible. So anything we can do to have an advisory board, a board of directors, co-investors that we know, it's really something that you should foster.
I mean, it's invaluable.
Yeah, and the other point I'll make is, well, to what you said, we look for companies proactively, but we also get investment opportunities from referrals. So to the extent you build an advisory board that knows investors and has access to investors, nobody reads, very few investors invest off the transom.
Wouldn't you rather have them be knowledgeable in the industry, over knowledgeable about their background, like their school, high school?
Yeah, no,
teacher?
absolutely. But
Really?
if it comes from if you have an advisory member that can introduce you to an investor, that's invaluable from our perspective, because that's a first filter. If I trust your advisory board member already, have done business with them before, or they know our portfolio companies, the fact that there's an investment opportunity coming through that channel, we pay attention.
When looking at a deal, and we have data rooms, we look at a lot of transactions, I'm always shocked in some instances how little data our companies we look at that are real, that are generating cash flow, how little they do to report. What are the baseline things you want businesses or entrepreneurs to show you when they're pitching you for an investment opportunity? What's the baseline that they need to build and make it look good and be well thought through?
I think that's going to really vary by deal stage. So I'll take very early, and you guys can go up the ladder. But fundamentally, I want to see a cash flow statement or an income statement that adds up. You would not believe how much bad math there is in the world. That is a mistake when you're going to an investor. So I think that's probably the first and foremost. And I want to see where you are on your product roadmap. And where you are against your milestones. Lots of times the companies I'm looking at are pre-product. That's cool, we're all used to that, but tell us in real simple terms where you are and where you're going.
But also, would you add scalability and how you can actually scale this business? 'Cause
Well,
a lot
I
of
thought he was talking about reporting more than like projections. Maybe I missed that
Yeah,
question.
just help people in the audience understand as they pitch investors, what do they need to show you? I mean,
Right.
I would answer, you need a deck that describes a little bit on the past, but more on the future,
I
a
misunderstood,
robust
sorry.
financial model. Earlier stage things where that's a little fuzzier, there's got to be a way to convince the investors that you're going to get from A to B. I mean,
So let me add one point then. There are a lot of documents out there now for early stage companies. One or two of my personal favorites are the ones that Y Combinator have put up, Techstars has put up, and 500 Startups. Between them, they have a short list of stuff you need to have in your story. And you're absolutely right. It needs to talk about fundamentally your product, why you are 1,000% passionate about it, why there's an opportunity for it to be big, and how you're going to get there. So very simple points.
The main thing to us is that you have a plan that has room for an outside investor to make a rate of return that we need to have in a risk-adjusted world. If it's a good business for you, that doesn't mean it's a good business for the outside investor. Very few people should ever take outside money. The companies do not scale. The companies do not return capital. They provide a lot of heartache, and they should have really thought through it before they just jumped into things. So the main thing is to have a good sense of if we need a 5 or 10 times return on our money, and you have a business plan that talks about a terminal value, a sales approach out 5 years, we can do the math together as to how much we're going to have of the company to be able to get that rate of return from your business idea. And I guarantee you, most people's plans do not show that there's enough room for all of us. So put yourself in our shoes when you're running the numbers, and don't just play games with the hockey stick. Try to make sure that there's a vision of how big the business can be for insiders as well as outsiders.
I'll add two more quick points. One is unit economics. So understand your unit economics. If you only sold one thing of what you have, what would that look like? The second is understanding, however early you are, your sales cycle dynamics, or more importantly said, your customers' buying dynamics. And that's a very important thing to prove out, even with the first 10 customers.
all right, last question on pitching investors, and I want, this is free consulting right now. Pricing's one thing, right? We all want the highest price for our business, and that's great. But as I know, and you all know, terms and conditions also matter. What are some terms and conditions you're seeing sometimes entrepreneurs not putting enough thought into, where a year after they're down the path with an investor and they're either things aren't working out or things are working out great and now we have to raise more capital? where are people missing? Where are entrepreneurs missing on terms and conditions when they contract with their investors?
How much time do you have?
Top three, John.
When I give these workshops to wannabe angels and we talk about what should be in the term sheet besides valuation. So the first thing that always is the crunch point is what's the valuation, pre-money valuation. It makes a lot of difference if you've had multiple rounds of outside investment and these guys are coming in, let's say in a Series B or C, there's a lot of data points already there. The seed round, the A round, some value, some book value. When it's just winging it with an idea, this whole issue of how do we mitigate not coming up with the right valuation point by having some terms that we both mutually agree are acceptable. When I asked the angels what are the 3 terms that they would insist if I could only give them 3 terms besides valuation, the first is liquidation preference, so that the investor gets money out first. It could be as onerous as liquidation preference with a dividend, participating preferred, so that we not only get our money back times 1 or 2, but we also then get to convert and have a piece of the upside as well. So that's a sort of onerous way for the entrepreneur, but it will come to play if you have an overvaluation of what you're worth and you won't come down. We then come back with some terms that mitigate this being overly valued. Second is anti-dilution. Angels tend to have a heart instead of their mind sometimes, so it's good to have an anti-dilution clause so that if you have to come back for another round that's lower, we get to have some repricing of it because we overpaid with our heart. And last is a board seat, or at least an observer role. Very important to have information rights, a dashboard that comes into play monthly. So information rights, anti-dilution, liquidation preference for a startup or a first round of outside funding.
So I'm going to play devil's advocate and say from the entrepreneur's perspective, the opposite of those things are what's market standard, particularly in the big markets. So because entrepreneurs are driving these deals in a lot of these markets, liquidation preferences are going down, scaling down. They're not going away, but they're scaling down. And the idea that every angel should go on the board of every startup they're in is ludicrous. They should absolutely have information rights beyond a certain threshold. You know, what I typically see is you have to invest at least $50K to get information rights. But, you know, remember, as an entrepreneur, that means you're producing, you know, financial reports for every angel you sign that deal with for the rest of your life. So sign that deal carefully. And then the third point I would say is on valuation. We all think it's great to get the biggest possible valuation. We watch Silicon Valley on television, blah, blah, blah. But the reality is bad stuff happens. And down the road, you could have a down round, and then that's bad news for you and, as John said, your earlier investors. So think rationally about the valuation. Yeah, make it worthwhile, but don't go nuts.
So on the topic of valuation and sort of ownership over time, there's a good book out there called Rich versus King, which you all could just take a look at. It covers many topics, but this is one of them about the notion of how to think about the pie getting bigger versus worrying about ownership up front that then down the pike will mean nothing because you'd rather be the owner, a 10% owner of a $500 million company than an 80% owner of a $5 million company.
And that should be discussed in due diligence before you ever close. You should have that relationship of scale. No surprises.
I think we have a couple more minutes, and then we're going to open it up for questions. So just on a lighter note, wanted to get your perspective because I think this has been very helpful from what's going on in the market, how do we pitch investors. What technologies are you guys following most closely right now? What's going to change the world the most? We had the question earlier about 3D manufacturing, drones, and cars. What else? What else are you watching?
Smart grid and cloud-to-cloud technologies.
Elaborate a little more.
Smart grid technology. So specifically, I'm following things like remote battery management, sensors for oil and gas, for drones, because I'm an industrials guy. It's not very exciting, but it's what I love. So anything related to sensors that applies to multiple sectors. Battery management, again, not sexy, but applies to cable, utilities, wireless, the list goes on. And as well, cloud-to-cloud technology. So you're going to have people are going to start putting more in the cloud as they're obviously doing, but how do you communicate with the two disparate clouds between the two of them? So that's what I've been following lately.
As I said earlier, a lot of my work is international. So I focus on opportunities for the other 6.5 billion people who are not yet on the internet and will be shortly. And so fintech is a big one that I'm following. There are actually some of the most innovative things happening in technology in places like Africa. And that's pretty exciting. And then I think more broadly, Internet of Things, you touched on it in one area. We're seeing a lot of really interesting smart city technology, which again, are being implemented in places that you might not think of off the top of your heads, like Kansas City or Chattanooga, Tennessee. We're actually going to do a program, Angel Summit. Our next Angel Summit will be in the fall in Chattanooga. So those are the two big things I think I'm looking at.
We see, we feel like we're in the very early innings of mobility, actually. On the consumer side, it's more mature, but on the enterprise side, where we make most of our investments are related to solving enterprise problems, we're in the early innings of mobile adoption for the enterprise. There's a lot of, mobility for us in our minds is a platform shift, like mainframe to client server, internet to mobile. So every aspect of software is being changed, disintermediated, shifted by mobility. So again, a lot of investment opportunity there. The other area is data management. Enterprises can buy software out there to manage their network, their databases, the applications, et cetera. There's not a lot of software out there for managing data. And in a big data world, that's a huge problem.
And I just say, besides technology and innovation, which is sort of fun but not necessarily essential, I'd say two areas that have to have a lot of attention are ag tech and batteries for the consumer, for the automobile. You solve problems on the ag tech side and the batteries, you've saved yourself a whole lot of your GDP and your industrial infrastructure that can be used in productive ways instead of, well, anyway.
Okay, last question, then we'll open it up to the audience. You work with a lot of young people, a lot of young entrepreneurs. I'm still a product of the 70s, so I'm not a millennial. How do you find working with millennials? What's the most effective way to work with millennials today that may have different value systems than we have? And are there any sorts of direct examples you can provide of where you thought they'd be incentivized to do one thing and it really didn't work in that favor?
So my co-founder graduated from Carleton College in 2010, so I think that qualifies as working with millennials. I'm like, I have clothing older than that, But he's absolutely awesome. He's a brilliant guy. He's a serial entrepreneur, and it does a great job for us. And what I would say is inspiration. These guys are pretty jaded, and with good reason. We, as boomers, are leaving some pretty darn big messes on their hands. And so I think they want to feel like they are using their energy and their passions to not just make money, because they do want to make money, but also change the world. And so balancing that dynamic, I think, is really important with them.
One thing I like about it, and I'll use my younger brother as an example, is in something he said, which is, my generation likes to look through the prism in different ways, and that is helpful. I mean, what I've found is that young entrepreneurs look at the world in a different way, they look at opportunities in a different way, and as a result, you're seeing dynamic ideas along many different sectors and spaces, whether it's ag tech, whether it's, data recovery, you name it. It's quite remarkable. I've never seen anything like this before with this generation.
Well, I've got two children that are millennials, and they both are entrepreneurial, and so what I've found is that it's an important thing to communicate, not just parent to child or from generation to generation, but to really reach out and try to ensure good communication, because it's so easy for them to assume that, I grew up when there were black and white TVs. Who's this guy to talk to about this, whether he's at work as an employer or whether it be a parent. So I just encourage communication over and over again.
To me, John brought this up earlier about having this upfront conversation about make sure that you're aligned with your investor. So, imagination, vision, and trust across all generations, and that's the sort of approach we have on it. Meaning that the prism through which they look through is fantastic. I agree that there's some things going on today that none of us could have ever imagined. But at the end of the day, we try to draw it back to these 3 points: imagination, vision, and trust. And then we go on the journey together.
Because the fundamentals are always the same.
Right. We all have to deal with the same platform.
Thank you very much. Well, let's open it up to questions. I think we have about 10 minutes?
Hour
Or 5 minutes? Okay.
This is directed a little bit at John and then to the institutional. We've seen the institutional do Series A move up the scale. And you said earlier looking for run rates of anywhere from 1 to 5 million per month or quarter. And the angels typically been the first 1 million. I think that's how Dingman defines it. So maybe talk to funding the gap that between 1 and 5 million, that post-angel, pre-institutional capital.
Oh, just real quick, what we're finding is what I call the 250 club. There are a lot of people in the country right now who will invest 250 to 500, not necessarily as the lead, but they're beginning to get out there, whether it be family offices, super angels, angel groups, gaggles of angels, equity platforms, state seed funds. What you need to do is realize that you're not going to get all 500,000 to $1 million, let's say first round. After friends and family gets you up to $250,000, 300-400. Then after that, until 1 or 2 million, you've got to get the angel or the wannabe angel. You've got to bundle together a number of 250 groups, 250 to 500. Somebody has to be the lead, or else everybody can always back off and at the end hold off because there was no lead at the term sheet. But the lead term sheet doesn't have to be the deepest pocket, as long as they have good connections and you have good connections. If you've got a term sheet at a good price, you don't have to get it all from one source. You need to get it from a syndicate of players who are all sort of trying to grapple with how do I play in the venture space, and I can't do it in the big VC space, so I'll do it by co-investing with angel groups, super angels. So that's what I would do, is get a number of different sources.
John, what about folks who've had recent notable exits and or strategic investors? So for instance, the battery management company I know is talking to one of the founders of AOL, and that's to fill in that gap, that 250 gap. These are sizable folks who can actually help the company.
Couldn't agree more. People should realize that super angels, I mean, it doesn't help that our favorite example of this in town is Revolution, that goes out and gets 450 million and competes with these guys instead of startups. They're like NEA. They do 25 to 50 million startups. That's not where you're going to be able to bundle together a bunch of 250s. We need more of those kinds of next-gen groups. Dingman Angels, New Dominion Angels, your groups all over the country, Leslie, that you're working with. So it's just, you have to have a multiple number of sources to bundle it together.
Yeah, if I could add to that, we're seeing a growing evolution. When you get outside of New York and Silicon Valley, really everywhere else is different. And what we're seeing are a lot of kind of micro VCs, so they may be, like $20, $25 million funds that'll place checks of $500,000 to $750 in different markets. And it's usually, and sometimes they're all VCs, meaning they're investing other people's money. Sometimes it's a group of people who put together their own capital. So it's kind of ferreting them out that is important. The other thing that we haven't mentioned here is corporate. You kind of touched on it a little bit, but corporate venture capital had its biggest year ever in 2014. And some corporations like to do scale-up businesses, but some will do some really early-stage stuff. And across industries, Coca-Cola has a great corporate VC, fund. It's not just straight tech. Cargill does, So I think, cozy up to, once you identify, your target and what your number is, cozy up to the industry leaders and see if you can't find, and there may be, by the way, there are some pretty interesting things happening in that dollar range that are grants. I was on the phone yesterday. There's a Chinese competition that's being run globally, so people in this room would be eligible for it. They're giving away $1.5 million as the top prize, no strings equity. So there are some different ways to get creative about that kind of valley of death that they used to call it.
Maybe time for one more?
Yeah, thanks for the great insight. My name is Serge, and I'm the founder of the startup that has just been accepted in June 1776. And as we're building our product and starting to line up customers, I'd be curious to know what are you looking for in a startup of this stage as we get ready to get investors on board. What are you looking for? Is this a startup that you'd be interested to, in terms of the stage that we're at, to invest in?
A lot of customers and low valuation. Thank you. Next. No, go ahead. Give him the real story.
Well, I think you heard it earlier. And what I would say to you is you need to do more research on the different kinds of capital to find out how better to tune that question to your audience. So what Sever would look for and what I would look for would be pretty different. But, you know, it's what we talked about earlier in terms of, you know, team, product, market, and zeal.
Make sure you get a good mentor when 1776 says they're going to provide certain things. They've got a lot of people down there. It's a very crowded space. You've got to be noisy about what you need to help you maximize your experience. And one would be a mentor that understands the funding process.
Try to find Paul Singh now that he's down there. Nobody's written more checks in this town than Paul Singh.
Well, let's thank our panel, Leslie, Hank, John, and Sever.